Hi, student. How are you? Can you hear me? Okay. Welcome. Welcome in the class. I'm your tutor of SBR. My name is AbuBakar Siddique, and I have been teaching SBR for last 14 years. Today, our first class, and in the first class, first of all, we will have an orientation of the paper, understanding of the paper, and then we will commence the topic. So without any further delay, let's first of all discuss the uh, paper. So the paper we have is Strategic Business Reporting, known as SBR. Before SBR, the paper which provide the foundation of SBR, we have studied at skill level, that was financial reporting. And now after the financial reporting, the final paper of the reporting is Strategic Business Reporting, SBR, in ACCA. This paper of SBR will also provide you an assistance in a paper of advanced audit and assurance. So the paper we are studying here is not only relevant, or the topics we are going to study are not only relevant to the SPR, but they will also relevant your uh, advanced audit and assurance paper. SPR is available in various versions like UK version, like Singapore version, but our study version will be SBR International, INT. INT International will be the version of SBR which we would be preparing for December 2025. If we talk about the exam pattern of SBR, the paper of SBR will be a computer-based exam, means it would be a CBE exam, computer-based exam, first of all. And the paper will be consist of two parts, part A and part B. In part A, we have a question number one. This question number one will be having total 30 marks. There will be total 30 marks in the question number one. And the question one will be from group accounts and from multiple accounting standards. Primary focus of the question one is a consolidated financial statement, but there will be other issues as well, covering the accounting treatments or explanation relating to the various accounting standards, like maybe IFRS 5, maybe IFRS 15, maybe IFRS 37. Any accounting standard could be discussed other than the group accounts, along with the group accounts in a question number one. And total 30 marks would be available here. Then we have a question number two in a part A. This question two will be consist of 20 marks, and in these 20 marks, they will test us with various accounting standards, accounting issues, plus ethical issues. There will be an accounting issue, and along with that, there will be ethical issue relating to the accountants and the senior management. Okay. For example, there might be an accounting issue relating to a property which is an owner occupied property, IS 16, but your senior is asking to treat that property as an investment property and show the gain in profit and loss account instead in other comprehensive income. So that would be an accounting issue. But pressurizing you to do an accounting treatment which is not as per accounting standard, it creates intimidation, it may create self-interest, maybe because being an employee, you want to protect your job. So such ethical dilemmas can be tested in the question number two. So we will be having total 50 marks in a part A. And let me tell you one thing. It is a paper of the report. It is reporting paper like FR. SBR is also an reporting paper, strategic business reporting paper. But I would say that it's not a sort of a paper in which you expect to do a lot of calculation. Okay, like in FR, we do a lot calculation, a lot of numeric work. But in SBR, the situation would be a bit different. There will be calculations, there will be numericals, but I would guess that would not be more than 20% of the paper. If you ask me about the calculation, in my opinion, that would not be more than 20%, maximum 25 to 30%. So 70 to 80% of your exam would be consist of the requirement in which the examiner would ask you to explain an accounting issue or to evaluate or to analyze or to discuss the accounting problems in a given case study. So SBR is not sort of a numeric paper like a financial reporting. There will be some marks, as I told you, 20% to 25, 30% marks, but majority of the marks would be available on the basis of discussions, evaluation, and explanations. There will be an accounting case study which may have some wrong treatments, wrong classifications, wrong measurements, and you have to discuss the issues and you have to discuss the right things to do in the financial statement. So that sort of the paper we are going to discuss, we are going to study. And most important thing which I talk about in every class of the SBR, the paper name itself is SBR, Strategic Business Reporting, Strategic Business Reporting. So that means in this paper, you are at a strategic level, at the highest level of the company. Okay. Now, at the highest level of a company, the directors do not prepare financial statements. They are not part of the preparation of the financial statement. Yes, they will review it. They will review it. So if you are sitting at a strategic level, just try to understand your position, that you are sitting at the highest level of the management. And at the day end, when your staff, when your manager level staff will prepare the financial statement, they will send you for the review. So when you are reviewing the financial statement, you should have a very sound and strong knowledge of accounting standards and accounting treatment. If you have a strong understanding of the accounting standards, if you have a sound understanding of and strong understanding of the accounting standard, then you would be able to review the financial statement accurately. So ACCA in this paper is trying to tell you that the future of the accountant is not to prepare the financial statement. That thing would be done by the software. We are living in the times of the AI. Okay, so the preparation of the financial statement would not be an issue in the future or in a recent time. There are accounting softwares which do all the things which traditionally an accountant is expected to do. So if this is a change due to the technology, so what is the role of a chartered accountant then? The role of the chartered accountant is that the financial statement will be prepared by a software or junior staff or by any means of the technology. The role of the chartered accountant in a recent time and most importantly in a coming future would be to review the financial statement, because the software cannot think. The software will process the data. You will provide them the data, they will process it on the basis of the data provided in the software, but they cannot review it. That work still remain with the humans. So that's why this is a paper of the future, where the ACCA is trying to develop the habit that the future of the accountant is not to prepare the financial statement, that their role would be review the financial statement. Okay, so that's why in SBR, the more focus would be on explanation, on analysis, on evaluation, and on discussion of the accounting issues, of the accounting standards on a given case study rather than the numerical work. So now coming back to the part B of the question. In part B, we will be having two questions. There will be two questions in a part B, question number 3 and question number 4. And each question will be consist of 25 marks. So There will be 50 marks in a part B of the paper. And again in a part B, there will be a testing of accounting standards and plus the other issues like we have now a topic of sustainability reporting. We have a topic of alternative performance measurement. We have a topic of conceptual framework. We have a topic of accounting standard for small and medium enterprises. So such issues along with accounting standards would be tested in a part B, question number 3 and question number 4. So that's how the total 100 marks paper will be made of SBR, in which obviously the first target would be to get 50 marks to pass the exam, and then obviously we will try and we will work hard to achieve the maximum marks uh, um, as possible. Okay, so that is your paper pattern, which would be a computer-based exam. Any question? Okay, now. Okay. Now the study resource or the study resources which we will be using. First of all, I will provide you class notes plus past exam kit. I will provide you. It would be available on LMS, number one. Number two, other than class notes, the focus will be on ACCA Study Hub. You know that ACCA has launched the Study Hub where the books and the kits are also available. So I will be using the Study Hub as well. And along with ACCA Study Hub, I will also be using ACCA Practice ACCA Practice platform. So these would be the resources which I would be utilizing, and I would ask you to utilize to prepare the SBR exam. Other than that, if any one of you want to use a book to study SBR, in that case, my recommendation would be that you people should use the Kaplan. You people should use the Kaplan exam kit to study the SBR. Okay, but in my opinion, the class notes and ACC study hub would be enough. ACC study hub would be enough. Rather than, I would say, the most important thing now to prepare the ACCA exam is ACCA study hub. Is ACCA study hub is the most important available resource to prepare any exam at ACC level, because the material provided in the study hub is provided by ACC. So it would be 100% updated. It would cover the every aspect of the exam which could be tested in SBR. Okay. So the most important thing nowadays for exam preparation, dear students, that is ACCA study hub. More important than any book, more important than any class notes. The most important thing in the preparation of the exam is no doubt nowadays is ACCA study hub, is ACCA study hub. Okay, you got it? Any question? Okay, so now the next thing is to discuss the course plan. Now, dear student, I have divided the course plan in two categories. One of the category of the course plan is those accounting standards which we have completely studied at FR level, And the strategy would be for those standards would be that I will provide you a pre-recorded sessions of those accounting standards. And the purpose of this strategy is that so we can have a plenty of time to cover the topics which are more important at SBR level, and we can do a more practice questions. Okay, that is the purpose of that strategy. So you can see in a course plan, there are some lectures which will be provided you on the basis of pre-recording. Those topics includes provisions, contingent liabilities, and contingent asset, IS 37, asset held for sale and discontinued operations, IFRS 5, borrowing cost, IAS 23. These are the topics which we have or you have studied in depth at FR level, at financial reporting level. There is nothing new which we can learn at SBR level relating to these accounting standards. These are completely covered in FR. So I will provide you a pre-recorded sessions with keeping in mind with respect to SBR. I have recorded these lectures as per SBR practice. Okay, and the recording will be provided to you. The second thing I will provide you on a pre-recorded lecture would include IS 16, investment properties, government grant, intangible non-current asset IS 38, and impairment of impairment IS 36, along with the practice question, and IS 8 and IS 10. Now, these three areas I will provide you in a pre-recorded format. In a pre-recorded format, these lectures will be provided to you. Then the live class sessions, which we will do in a live class, it includes IFRS 15. IFRS 15 is an account standard. Revenue from customers, or revenue from contract with customers. IFRS 15, in this accounting standard, we will be learning about the revenue recognition, revenue measurements. Then the second class means the second session. IFRS 15 may take our 2 lectures or 3 lectures, because it is a very detailed accounting standard. So it would take maybe 5 credit hours. Then next would be the segment reporting, IFRS 8. IFRS 8 covers the issue of the segment reporting. Now, what is the segment? Dear student, if I talk about the Samsung Incorporation, Samsung company, Samsung is a company, they prepare their financial statement, but they involved in various products line. They involved in mobile phones, they manufacture smart TVs, they manufacture the refrigerators, they manufacture the air conditioners, each and anything you name it, and they are making that product. Now, being an investor of the Samsung company or the user of the financial statement of the Samsung company, I would be interested to know the overall company, okay, is profitable, but I would want to know how the major products lines are performing. So to fulfill that need, we have a mechanism where we disclose the information relating to financial performance and financial position of the major product lines and the geographical areas. And for that purpose, we have IFRS 8 segment reporting. Then we have IAS 24. IAS 24 is a related party transaction. IAS 24 is a related party transaction accounting standard. It is also a disclosure-based accounting standard, in which when company do a transaction with a related party. Now, who is a related party? Related party is an entity or is a person who can influence the transaction which they are doing with the reporting entity, like the directors of the company, like the close family members of the directors, like parent company, associate company, like subsidiary company. These are the related parties of the reporting entity. So there is a chance when there will be a transaction between the reporting entity and the related party, that transaction might not be done on fair basis. So it is required by law as well that whenever there is a transaction with the related party, that must be disclosed in a financial statement. So the user of the financial statement can assess the terms of the transaction on which the transaction has been taken place. So to fulfill that need, we have IAS 24. Then we have the fair value measurement, IFRS 13. IFRS 13 would be the next accounting standard. In IFRS 13, you know that in various accounting standards now we have a concept of fair value. Like in IAS 16, we have revaluation model. In IAS 40, investment property, you know we have fair value model. In IS 20, we have a concept of fair value. In IS 36, impairment, we have a concept of fair value. Then financial instruments, we have a concept of fair value. So there are a number of accounting standards where we have a fair value issues or fair values by year. So what is a fair value? How to determine the fair value? All these issues would be covered in IFRS 13, fair value by year. Then we will conduct a test as well when we complete this session. And in that test number 1, all the above topics will be covered. Then the next grade will be started, or the next area of the syllabus will be started, which is again the live, include only live classes, in which we will cover employee benefit IAS 19. Employee benefits, basically the benefits provided by employer to employee on the basis of their services, like monthly salary, like pensions, provident fund, gratuities. These benefits are known as employee benefits. Now, how to account for those employee benefits, we will learn in IS 19. Then we have share-based payment. Share-based payment is an accounting standard known as IFRS 2, share-based payment. Now, share-based payment means normally when entity purchase something or buy something, they give consideration in a form of the cash. In the form of cash, they give the consideration. But sometimes the companies give consideration in a form of their equity instrument, like Coca-Cola is a listed company. They purchase a plant of, let's say, 400 million US dollar. Now, instead of paying a cash to a supplier, they may offer the supplier to accept certain number of shares of the Coca-Cola as a consideration. And if the supplier accept that offer, and I think the supplier will do, because we are talking about a company which is a multi-billion dollar, whose operations are across the globe. So supplier would accept that offer. That payment then will be known as a share-based payment IFRS 2. Similarly, sometimes they give consideration to the employee as well in a form of share-based payment, like you have may have heard, like executive share options or executive share option schemes given to the directors of the company. That is also a share-based payment for the services of the directors to the company. Now, how to account for those transactions, we will learn in IFRS 2. Then we have IFRS 16, leases. Some part of that lease we have learned in FR, but majority of the part we will cover in SBR. Like we will cover here again the lazy accounting, but we will also cover here ledger accounting, sales and lease back, lease modifications, lease reassessment, and sublease, concept of sublease arrangement. All the lease relating issues we will be covering in IFRS 16. Then we have financial instruments, in which we will learn about the accounting treatments of the financial instruments, like trade receivables, trade payables, preference shares, ordinary shares, debentures, loan notes, convertible loan notes, derivative accounting, hedge accounting. So number of issues we will cover relating to financial instruments, like financial asset and financial liabilities in the topic of financial instruments. And the accounting standard we will be covering here will include IAS 32, IFRS 9 and IFRS 7. IFRS 7. These three accounting standards we will be covering in financial institute. Then we have IS 12. It is an accounting standard of taxation, that how to account for the taxation in the financial statements. Okay. For that purpose, we will be doing IS 12. And then we have a change, a new topic. You people know that the preparation of the financial statement was covered in IAS 1. IAS 1 was the accounting standard, which cover the topic how to prepare the financial statements, how to prepare profit and loss account and other comprehensive income, how to prepare statement of financial position, what is current asset, what is non-current asset, what is current liabilities, what is non-current liability, all these issues covered in IAS 1. Now, this IAS 1 has been replaced by a new accounting standard, which is IFRS 18. So the news is that we are not going to learn IS 1 anymore, because now we have IFRS 18. IFRS 18 is now the new accounting standard which covers the topic relating to preparation of the financial statement. And there are some changes as well in the format of the financial statement as well, especially in preparation of the profit and loss account. There are huge changes. There are huge changes in preparation of the financial profit and loss account, presentation of the profit and loss account, format of the profit and loss account has been changed very significantly. So for that purpose, we will learn IFRS 18. It is very important one, because the question number 1 will be covering the consolidated financial statement. And in consolidated financial statement, we have consolidated profit and loss account as well. So if there is a change in a format of the profit and loss account, then obviously we have to learn it, because if they test us the consolidated profit and loss account, then that profit and loss account should be prepared as per the new accounting standard IFRS 18, not as per IAS 1. Now, due to IFRS 18, there are some changes as well in a cash flow statement as well. But all these changes we will discuss in IFRS 18 and the relevant topics. And after that, there will be test number 2. And then we have the next area. And in that next area, we will be covering the basic group accounts. Basically, we will start the consolidation here. We will learn IFRS 3. IFRS 3 is an accounting standard which covers the accounting of business combination. IFRS 10, again relating to the consolidated financial statements. Then we have another accounting standard, IFRS 11, which is a joint venture, accounting for associate and accounting for associate and joint venture, IS 28. We will do these accounting standards. Then we have, after the basic group account, we will learn business combination in steps. Step acquisition, we acquire 10% of the company, then we acquire further 30%, it become associate, then we acquire another some acquisition more, and the associate become our subsidiary company. So that acquisition is known as step acquisition. We will study the disposals of the subsidiaries and associates. We will have a Forex IS 21, which includes the foreign subsidiary as well. Foreign subsidiary, if you have acquired a company or a foreign operation, and on that foreign operation we have a control, how to consolidate, what are the issues we have to cover in the consolidation of a foreign subsidiary, we will discuss in IS 21. Then we have a consolidated cash flow statement. We will learn how to prepare the consolidated cash flow statement. Then we have APM, alternative performance measurement. We have some current issues like IFRS 18 would be the current issue. We have a topic of sustainability reporting. So these areas we will be covering at the end. So that would be your course plan, the topics which we will cover in the SBR. And as I told you, the some topics I will provide you in a recorded format, and mostly the classes will be the live classes. Okay, and these recorded lectures would be available on LMS. Okay, in a coming days. So when I will make available, you can watch those lectures as well. You can watch those lectures as well. And let me tell you one more thing, which is part of the plan, and I would like to discuss that thing in the start of the class. Okay. Dear students, in a month of August, and it is not confirmed, but it is, I can say 80 to 90% it is confirmed, but I am keeping 10% chance, 10 to 20% chance. But uh, on the class on which be would be taking place on 3rd of August and 10th of August. In these 2 days, in these two classes, basically I would not be available. I would I would be traveling. Okay, I have to go abroad for something. So in these 2 days, I would not be available. So the class on 3rd of August and 10th of August, I would not be taking. So what you can do in these 2 weeks, you can go through the recorded lectures. You can go through the recorded lectures which I will provide you. Okay. So keep in mind in a plan, the class on 3rd of August and class on 10th of August would not be taking place, due to some traveling reasons. Okay. And I will confirm it is 80%, it is 80% confirmed. It is 80% confirmed. It is 80% confirmed, but I will confirm you at the end of the July. Okay. But you people should keep in mind in these 2 days, 3rd August and 10th of August, the class would not take place. Okay. Kindly note it. Any question? Just give me a minute. I want to show you something. Okay, I think there is some internet issue. Site is not opening. So I will do this thing later on. Okay, students, that was the orientation of the paper, Strategic Business Reporting. Now, if you have any query in your mind, you can discuss that thing. Any question? Do you have any question? Okay, the notes will be available on LMS. Uh, and I think they would have made available, but I will ask them if they do not. But the notes will be available. Are you registered on LMS? Hashim. Okay, this is the first class. This is the first orientation class. Um, I think they will make available in this week. Before the next class, the thing will be available. Okay, they will be make available. They will made available. Okay, so now we have we have complete the orientation, and now we will start the class with the topic with the topic, the first class, and we will follow the you can say the pattern which I have provided here in the SBR plan. So the first topic we have is IFRS 15 revenue. IFRS 15 revenue, and we will start this topic. But before that, we will take a break, short break for 10 minutes, and after the break, we will start the class. So kindly take a break. Okay, welcome back. So now, without any delay, let's start the first lecture. It's revenue from contract with customers. IFRS 15. In this topic, the objective is to know that how to recognize the revenue and number two, how to measure the revenue, how to recognize the revenue and how to measure the revenue. That is, you can say, the objective of IFRS 15. First of all, if we define the revenue, that what is the revenue? Dear student, revenue, if we define it as per the standard, revenue is the income generated from ordinary activities of the business. The income generated from the ordinary activities of the business, that is known as revenue. Now, ordinary activities mean the normal trading activity for which the business has been established. Like for Apple Incorporation, their ordinary activity is to sell iPhones, MacBooks. It is their ordinary activity. So the income which they will generate, the gross income they will generate by selling their products to their customer, by selling their products or services to customer, that would be known as a revenue. And the customer under IFRS 15, customer is an entity which buy ordinary goods or services provided by the entity. So that means every buyer is not a customer. Like if we talk about, let's say if we talk about Hamzah Academy, the ordinary activity of the Hamzah Academy is to provide the tuition services. If the student is buying those student tuition services provided by Hamzah Academy, by definition of IFRS 15, he is a customer. But if any student buy like a old laptop disposed by the Hamzah Academy, if the student buy a laptop, he is a buyer or she is a buyer, but not a customer. As per IFRS 15, customer will be a person who buy ordinary goods produced or services provided by the entity. That entity will be known as, or that person will be known as a customer under IFRS 15. Now, one thing you people should keep in mind, the principle of IFRS 15 is that revenue is recognized when the control is transferred. When to or how to recognize revenue? When the control is transferred. And it is measured at a price which entity expect to receive from the customer. So, on a principal standing, if someone asks when the revenue is recognized, our answer will be when the control of the thing is transferred. Okay, when the control will be transferred, the revenue should be recognized. The second question is how to measure. The revenue should be measured at a price which entity expect to receive from the customer. Now the price which entity expect to receive from the customer, keep in mind in IFRS 15, that price is known as transaction price. That price is known as transaction price. Transaction price. But obviously, this transaction price does not include, this transaction price does not include the price or the amount which entity has received from the customer as a third party. Like the transaction price does not include the VAT, value addition tax, because the VAT which is received from the customer is not the revenue of the entity. It is basically the entity is receiving as an agent, and the VAT received from the customer will be paid to the government. So transaction price does not include the price which the entity received as a third party. Okay, other than that, the price which entity expect to receive from the customer at that price, which is known as a transaction price, at that price, the entity will recognize the revenue. Okay. Any question? Any question, students? Any question? Now, in IFRS 15, we follow five-step model. We follow five-step model to recognize and measure the revenue. Five-step model. So we follow five-step model to recognize the revenue. Number one, that contract with customer must be identifiable. The contract with customer must be identifiable. Now, when the contract will be identifiable, in simple words, if it can be enforced at law. And when the contract is enforceable at law, number one, when there is offer and acceptance each party rights and obligations can be identified when the terms of payments are clear, when it has commercial substance, when it's probable to recover the consideration, cover the consideration, cover the recover the consideration from the customer. So contract will be identifiable if there is proper of offer acceptance where the entity can identify each party rights and obligation, where the entity can identify the terms of the payment, when the contract has a commercial substance, it is not of a social nature, and entity expect that it is probable that they will receive the consideration from the customer. If these elements are exist in a contract, then the contract is identifiable. Now, for example, if there is no proper offer acceptance, if the terms of the payments are not finalized, for example, if we have sold something to a customer from whom we does not expect to recover the amount, then it means the contract is not identifiable. And if the contract is not identifiable, that means the revenue cannot be recognized. So first of all, the most important thing is that the contract should be identifiable with the customer in order to recognize the revenue. Now, one more thing which I would want to emphasize. Look at the condition number 5. It is probable to recover the consideration from the customer. Now, for example, all the things are fulfilled, but you sold something to a customer, like for example, for $100, but at the time of sale, but at the time of sale, you know that ability of customer to pay is only $80. Is only $80. When you sold the thing to a customer, you know that normally you sell the item for $100 and you sell it for $100, but you know that your customer can pay only $80 Then according to IFRS 15, it is implied trade discount. There is implied trade discount of $20, which should not be part of the revenue, which should not be part of the revenue. You cannot record the revenue at $100 and then you record a bad debt of 20. That would be the, in calculation terms, that would result would be the same. You record 100 and then you record the bad debt of 20, but that would be the wrong treatment. According to IFRS 15, when you sell something to a customer, you record the revenue at the price which is representing the ability of the customer, that the customer can pay. So if you know that your customer can pay $80, the reason could be the financial difficulty of the customer or the economic downturn, but you know it, that it is probable that $20 would not be received, then according to IFRS 15, the $20 is the implied trade discount, is the implied concession. So the revenue should record it to 80. The entity cannot record the revenue of $100 and then record the bad debt of 20. That would be the wrong treatment. That would be the wrong treatment. Another example of the identification of the contract. Another example. Another example of the from the identification of the contract. Like for example, X and Y in a get together, X told Y that the X need some some laptops and Y is the trader of the laptop. The next day, Y, without any finalization of the terms and conditions, the Y sent 100 laptops to X. Now, the laptop has been delivered, but the contract is still not identifiable because there is no proper offer acceptance. There is no identification of each party rights and obligations. The terms of the payments are not finalized. So the contract is not identifiable unless X accept the goods and make the payment to the Y, which is non-refundable. In that case, it would be identifiable. Otherwise, for Y, the contract is not identifiable. And if the contract is not identifiable, then the Y cannot recognize, the revenue as well. Okay. So first of all, the thing which is most important, that the contract should be identifiable. Number two, the step number two is the identification of performance obligation. Identification of the performance obligation. Now, what is a performance obligation? Performance obligation is a promise or promises in the contract. Promises in the contract to deliver goods or services which are distinct or series of distinct goods or services, series of distinct goods and services which have the same pattern of delivery, which have a same pattern of delivery. Performance obligation. So performance obligation is a promise in a contract. Is to deliver distinct goods and services or a series of goods and services which have the same pattern of delivery. Now, we have a word of distinct. Distinct means an identifiable separate performance obligation. Now, for example, I would elaborate the concept of the distinct performance obligation through an example. Like, for example, we have a contract with our customer in which we will provide them a software installation of the software updates of the software, and number 4, let's say technical support. Now we have made multiple promises in a contract with our customer. Now, in this contract, we have to determine, how we will determine it, it is a separate question. But we have to determine that how many distinct performance obligations do we have in this contract. Now, there are multiple possibilities. We may have, we may conclude that we have 4 performance obligations, or we may say we have 3 performance obligations. We can say we may have 2 performance obligation, or we can say we have only 1 performance obligation. When I'm saying that we may have a 4 performance obligation, in that case, delivery of software is 1 performance obligation, installation is a 2nd performance obligation, providing the updates is a 3rd performance obligation, providing technical support is a 4th performance obligation. And in case of 3 performance obligation, we may have to integrate the software installation into a single performance obligation. And in that case, the update will be the 3rd and technical support would be the 4th. Or in case of 2 performance obligation, we may integrate 1 and 2 into 1 and 3 and 4 into 1. So software installation is a 1 and update and technical support may be the 2nd. Or we may conclude all these 4 promises are basically only 1 performance obligation. So that thing need to determine in a step number 2 that how many performance obligations we have in a contract. Now, how we will determine it, I will talk about later on, but that would be the step number 2, that to identify the performance obligations in a contract. The step number 3 is determination of transaction price. Now, what is a transaction price? I have defined here the price which entity expect to recover from the customer or receive from the customer. But it does not include the amount which we have collected on the behalf of the other party. For example, value addition tax. So in a step number 3, we have to determine that how much amount we expect to receive as a consideration from our customer. Now, in that determination, there are number of factors which I will be considering. How I will consider it is a separate question I will talk about later on, but I have to consider the variable consideration and constraints attached to the variable consideration. Number 2, financing components. Now, if I give you a brief example of variable consideration, like for example, we have a contract with a customer to deliver 100 units of our residential complex, and we have agreed $100 million. But as per the term, if we deliver the residential complex within a 1 year, they will pay us extra 10 million US dollar. They will pay us extra 10 million US dollar. Now, in this case, $100 million is a fixed consideration, and the extra 10 million, which is contingent upon some future events that we have to complete that construction within a 1 year, that is a variable element. And whether we can complete it within 1 year or not, that is a constraint. So that is a variable consideration, and the constraint attached to the variable consideration, which we have to consider in determination of the transaction price. Then the second element we have to consider is the financing component. Look, when we sell something on cash, the price is different. But the same thing, if we sell on a credit, obviously the price would be the different. And the principle is that whenever you recognize the revenue, that should be equivalent to the cash price. That should be equivalent to the cash price. So if you are receiving anything more than cash price or less than the cash price, that is a financing component that need to be considered in determination of the financing component. The third thing which we have to consider in determination of transaction price is known as non-cash consideration. Sometimes customer pay us not in cash but in other forms, like the customer may give us the shares of their company, equity of their company. That is a non-cash consideration. Or instead of giving cash, they may give us a real estate, a property. That is a non-cash consideration that need to be considered. And the fourth element here which we will consider is known as consideration payable to customer. Now, when we will determine the transaction price, we will consider all these four elements in determination of the transaction price. Now, the question is how we will consider it, how we will incorporate it, we will talk about in detail later on. Okay, so that would be the third step which we need to consider in the determination of the transaction price. The step number 4 is allocation of transaction price. Now, for example, we have, let's say, 4 performance obligations like software, installation, updates, and technical support. 1, 2, 3, and 4. We have 4 performance obligations. And we have sold all these 4 performance obligations for 100,000 US dollars. It is known as transaction price. Now in a fourth step, we have to allocate this $100,000 among the four performance obligations. If we have four performance obligations, we have to allocate these transaction prices among these performance obligations. And we allocate the performance obligation among the transaction price among the performance obligation on the basis of a price which is known as stand-alone price. Stand-alone price is a price if I sell the goods and services separately. The price I would charge, that would be the stand-alone price. Like normally if I sell the software, I sell the software $70,000. Installation services I sell for $10,000. Updates I provide for $15,000, and the technical support I give normally for $20,000. So if I give the total, it will give you 1,50,000 $15,000. That is a standalone price. The price which I normally charge for the goods and services if I sold them separately from the customer. But I sell all these things only for $100,000. That means I have given the discount. So after giving the discount, the price which I expect to receive from the customer is 100,000 US dollars. Now this 100,000 US dollar I need to allocate. Among the performance obligation, and it will be done on the proportionate basis of the standalone price. So what I will do for software, I have $100,000 divided by 1,15,000 multiplied by $70,000 multiplied by $70,000. So if you do the calculation, okay, so the price is total is 100,000 divided by 1,15,000 into 70,000. I would have the transaction price for the software. So the software transaction price will be 60,870. Now same for the installation. For installation, $100,000 divided by 1,15,000 into $10,000. It will give you 8,696. Then for updates, 100,000 divided by 1,15,000 into 15,000. It will give you 13043. And then for the last one, That would be 17,939. So we will allocate the transaction price on the basis of standalone price. Okay, that would be the fourth step, allocation of the transaction price. And then we will have the final step, which is the step number 5, and it is revenue recognition. And revenue is recognized when performance obligation is satisfied. And performance obligation is satisfied either over time or either at the point in time. When it is over time, revenue is recognized over time. When it is point in time, revenue is recognized point in time. Now, how it will be determined, that would be an separate discussion, which we will do in detail in later on. But briefly speaking, this is the introduction of the IFRS 15, which we are going to study. So how to recognize the revenue and how to measure it. The principle is that when the control is transferred and at a price which we expect to receive from the customer. And to recognize revenue, we follow 5-step model. In first step, we should identify a contract with the customer. In second step, we should identify the performance obligations in a contract. Then in a step 3, we should determine the transaction price. In step 4, we should allocate the transaction price. And step 5, we should recognize the revenue when the performance obligation is satisfied, means when the control is transferred. And when the performance obligation is satisfied, either it would be over time or either would be point in time. So this is a 5-step model which we are going to follow in the revenue recognition. Now, in a coming class, I would be discussing the each step in detail, okay? From step number 2. Step number 1, I have discussed the identification of the contract. It has been discussed. Now, from the next class, I would discuss in detail, starting from the step number 2. We will talk about in detail about the step number 2, that how to identify whether we have one performance obligation or multiple performance obligation. Then we will discuss the determination of transaction price and so on. So in a coming class, I will be taking you in more detail relating to 5-step model and the remaining topics of the IFRS 15. Okay. So that is the from my side for today. Now in the next week, I will continue with IFRS 15, and hopefully you people will be joining in the next week. So that's the end of the class for today. Now, if you people have any question, any feedback, you can ask me. As far as the notes are concerned, I have asked the management to upload the notes on LMS. Hopefully, the notes would be uploaded. Those notes consist of 3 volumes, volume 1, volume 2, and volume 3. IFRS 15, I think in a volume 1 or a volume 2, you have to search on it. But I think it is in a volume 1, and there is a practice kit as well. Now in the next class, when I will discuss more in detail, and then I will do a practice question as well on the topic. So till then, goodbye and take care. If you have any query, you can ask me. Otherwise, we will close the class. Any question? Okay, dear students, then goodbye and take care. See you next week.